Hi, what is up, guys? It is John Fibonacci here, and in this video, I want to go over the importance of New York Open. All right, so it's going to be similar to London, the importance of the London Open, but it's just a little bit different and different asset that we're going to be looking at today as well. All right, just like in previous videos, when I talk about what I like to trade in each session, so like euro, British pound, for example, fiber and cable, respectively, I like to look for those. I like to look at for London, okay, and New York as well, or sometimes the overlap. But since London is first prior to New York for me, that's what I like to look at. So once that New York Open comes for actually the stock exchange, that's when I like to look at the indices. Okay, so I love indices around that New York Open and the first couple hours. All right, but before I get ahead of myself, there it is. All right, so why New York Open? Okay, so the New York Open occurs at 9:30 a.m. Eastern Standard Time, and for me, for those of you who don't know, since I'm from Texas, all right, I live in Houston, okay, we're an hour behind, so 9:30 a.m. Eastern would be 8:30 a.m. Central, all right, so you'll see my charts that are Central Standard Time instead of Eastern. I know a lot of traders who are in different time zones that like to tailor their TradingView time zone to New York, but that's just not something that I do personally. All right, so it is what it is, but that's it. Okay. So the stock exchange opens and the volume increases. That's basically when everything starts. Starts pretty much. Okay, the volume rolls in and everything gets rolling. Okay, and so just kind of like how I was saying a second ago, that's when the volume increases, and I'll show you that in a chart form. And you guys already know I don't use indicators and stuff like that, but just to kind of give you a perspective, and you can do this on your own charts if you want to add volume just to look at it. Okay, but this is just for demonstration purposes. You can see at the bottom, okay, that between London on the far left side, it says 02. I know that might be kind of hard to see, but on the far left side, that's pretty much where London is. And then that green arrow at the bottom is pointing to the first green bar of volume. Okay, that's the New York Stock Exchange Open. And boom, you know, volume rockets a lot higher. Okay. And so that's what I mean by the volume increases. And then the volume, you know, changes throughout the day. There's a morning session, afternoon session, and stuff like that. But I'm not gonna really be getting into the afternoon session today, and I'm not gonna go over the profit taking hour or anything like that today. We're really just gonna be focused on the open and why I feel that it's important. Okay. And when I look for trades, it's usually within the first, ideally, like in the first 1 hour, but it could go as far as like 10:30 a.m. for me, which would be 11:30 New York. So that first 2 hours, and then a little bit after that is really when it gets towards lunchtime. Price tends to sometimes not really do much in the middle of the day, and then volume kind of picks up. Volatility picks up after that into the afternoon session, and there it is. But yeah, so today's focus is really just going to be the opening price and kind of why it's important. All right. So we're going to be taking a look at the Micro E-mini S&P 500 index futures. That's what I trade, the Micro E-minis. Okay. And this is the March 2021 contract. All right. We're looking at a 5-minute time frame, and if you're watching this video the day I put it out or shortly after I put it out, this day was December 28th, 2020, so like a couple days ago. All right. That way, for those of you who do go back and study your own charts, it's not like I'm reaching back, where you can't study it like you can. Like you can look at the same data that I'm looking at, but in your own charts on your own screen. And just a little bit different that way versus, just looking at my charts and going from there. But nonetheless, still an introduction, and I want you guys to be able to go back and look at your own charts, and I hope that you do that versus just watching it, watching this video and saying, all right, like that's cool, like whatever. It's important to go back and study your own charts. All right. So the black line, okay, is my indicator. There's like a whole separate video on that, so I'm not gonna go through all of the details, but basically there it is. It plots 8:30, and then I just recently changed it to where it ends at 1500, which would be 3 in the afternoon Central, which I believe is 4 p.m. New York. I think that should be right. But anyways, so the beginning of the line is New York Open. Okay, and even on the top left, I don't know if you can see that, the top left under March 21 on the actual chart at the very, very top, it does say 8:30 to 1500. So there you go. But anyways, the far left side is the opening price. And so you can see that candlestick is a down candlestick, right? So let me go ahead and point this out to you. Some of you maybe not seeing what I'm talking about. So right there in the red shaded box, you have that black candlestick, which is a down candlestick for me. Okay, white candlestick means the price closed higher. The black candlestick means that price closed lower. Okay, and so that black candlestick there, the first 5 minutes of the open is down movement. Okay, and I put a little frown face in there to kind of indicate sentiment in a way where it's like, okay, if everyone woke up, or they've been up for a while, they had their coffee and everything, and they're ready for the markets to open, and let's just say they're bullish for whatever reason. Maybe they are holding on to a trade from the previous day or the previous week, something like that. They want to see the market rally, or maybe there was some news that happened last night and they just think the market's going to go higher. So what happens is the market, 8:30 hits, they ring the bell or whatever, and all that, and then price immediately drops, and that's kind of the important part. It's like that 5-minute candle drops, and I'm just gonna eyeball it, but it looks like it goes from 37.23 down to about 37.17, maybe 37.16. So it's kind of a quick drop. What's that? 4, 5, 6. Wait, hold on. 4, 5, 6, 7. So it's like 7 points, right? Something like that. I don't know. Nonetheless, it drops rapidly. Okay. And so traders who are long don't want to see price go lower, right? So they kind of like, it builds sentiment, right? And not only that, but it also is able to take traders out of the market who maybe have their stop losses at a low or something like that. And we'll get into that as well. But outside of like market manipulation, okay, there are still other reasons that this occurs. Okay, so they're like, okay, so from 6 o'clock, right, on the chart, from about 6 o'clock up into the open, there is a channel, I guess, if you will. There's really clean price action going to the upside, and so I'll show you that here, where you have a trend line here. Okay, and so I don't trade this way. You'll never see me trade this way, but just for, again, sake of presentation, there are people who do trade this way, where maybe they want to play a trend line breakout to the downside or something like that. I don't know why you would want to do that, but again, people do that. Okay, so assuming that maybe traders saw that, oh, trend line break, or some type of maybe they had a sell stop just a little bit below the market, and so they got triggered. The sell stop got triggered on the way down. Okay, so maybe the short sellers are from the trend line are now in the market, and so they're profiting as the price is going lower. Again, we're still focused on the open. Okay, so that first 5-minute candle goes down and the short sellers are in profit. Okay, so now think about this for a second. If you're in a short position, where would your stop loss go? And a lot of the way people trade is that if you're in a short position, your stop would go below the most recent high. Okay, or even a high above that if you have a little bit looser of a stop loss, or maybe you're trading on a little bit higher time frame, so you just pick a different high or whatever. Okay, so that's cool, I guess. Not something that I do again, but that's just what people do. Okay, so check this out. So where those stop losses would be, okay, I put in red for you, obviously, the most recent high and the bigger high to the left of it. So when the market then rallies, all right, the short sellers have now been taken out of the market. Okay, and which is good anyway, because it's better to be knocked out early during a run before price, runs for the rest of the day. So in a way, that's not a bad thing. And I don't really short the S&P or any of the other indices that often, just because stock markets generally bullish in the long run. So I don't really short markets that often, but hey, people do. All right. So it's interesting to see the short sellers getting stopped out here. But we need to also back up for a second, because we need to see what the buyers were doing as well. And this is what I believe is more important, because like I said, markets are usually bullish almost always. Okay. And you're going to have down days in the market, of course, duh. But I'm saying if you did the math, the numbers to the upside severely outperform on the upside than they do on the downside. Okay, and that's what I mean by that. And we're at all-time highs anyway for pretty much a lot of these stocks and a lot of the indices as well. Maybe not all of them, but I know we've hit multiple all-time highs throughout this year. Okay, so markets are bullish, and that's that. Right, but anyways, so when you look at the open, and price drops down, if you look to the left, think about what I asked you earlier. If people are long and they have a tight stop or even a trailing stop or something like that, where's their stop going to go? If they're focused on price action at the open, well, what's the most recent low? It was that same one from the trend line that I showed you earlier. Okay, so check this out. Before the short sellers were taken out, the longs, okay, the bulls were also stopped out, okay, beforehand. So again, the market opens, drops lower rapidly, and really just guns, and I say guns for a reason, and you'll find that out at the end, okay? The market guns for those stop losses right there at the most recent low and another low after that. Now, it didn't go all the way to the other previous lows at the beginning of the London session, but it's still, the market managed to take out some traders who happen to be having their stop at those areas. And then as well, you do have sell stops down there as well. Okay, but I didn't really include that in here, but it acts in the same capacity. Below recent lows and above recent highs, you're going to have both either buy stops or sell stops. And then on top of that, stop losses. It'll be the same, like all those orders will be in the same area or near the same price levels, but in different capacities. So I might have a long position and I might have a stop loss there, and that order for me is a stop loss. Other people might see that same area and want to go short at that area, so they're going to place a sell stop, and again, to take the other side of my trade. So in a way, like it could be different orders, but ultimately still buy stops and sell stops. But I'm giving you the details because it's not like the traditional way of using a buy stop, meaning I want to catch price as it's going higher. A buy stop could be used as a stop loss for short sellers, and that's what I mean. So if I confused you right there, you may have to kind of maybe rewind it or something. But anyway, let's move forward. So market opens, drops lower rapidly. Anyone who was long that had their stop losses at those two spots that I have for you on the screen, they were taken out. Also, short sellers who were on the other side of those longs getting stopped out are also shorting the market now, but they shorted at the low because you already see on the chart price rallies for the rest of the day and even in the after hours trading heading into the next day. Okay. And so that's kind of what's frustrating as well. And I know this has happened to a lot of people who have traded, I'd say at least for 6 months or more. And it's happened to me too. It's nothing to be ashamed of, but here it is. The long holders or the bulls who were taken out early missed out on this entire move plus more, because actually if you go back and you look at the chart, this market rallied a little bit more than it did on the screenshot, but the whole point was to show you the open and after, not like how far the market rallied. Okay, that's another story, you know, that's a different topic, but nonetheless, right? And think about that, like think about that for a second. How many times has that happened to you where you expect the market to go higher or lower, but you get stopped out, and then where you got stopped out ended up being the low of the day or maybe near the low of the day, and the market still went in your direction, right? That's frustrating. I know it is. But it's on purpose though. It's on purpose. Okay. And I'm not going to go any further than that. I'm going to just leave it there. Okay. So let's go ahead. This was an example for a what is it? A bullish scenario where the market took stops and then rallied, and so now we're going to look at the reverse of what this would be. Okay, so let's go ahead and go from here. Okay, so again, micro E-mini S&P index futures, March 2021 contract delivery month, 5-minute time frame, and this is the next day, which is December 29th, 2020. Okay, so we I know the chart's like not super clean, but you know, it's just the futures data. All right, and this is a 5-minute time frame. It's majority London session heading up into the open. All right, so if you look at the chart on the far right side, right at 37.44, you have the closing of that candle. So the next candle, I believe, is the open, or maybe yeah. The next candle would be the opening of New York. Okay, and so just like I told you, where traders are going to have their stop losses somewhere, or buy stops or sell stops somewhere. So on this chart for you, where would that be? Okay, you've got some highs, you've got some lows, and there it is. Okay, so if you want to look at this chart a little bit longer and kind of do your own exercise, you could pause the video here if you want to, and kind of look at this chart a little bit and then move forward after you're ready. So go ahead and do that now if you want to. But if you're just continuing to watch, then here we go. All right. So welcome back if you pause the video, and let's keep it going. All right. So from my perspective, this is what I would have on my charts. I would say, okay, there's buy stops, which is traders going long there. And then all I did was on TradingView was right click and then copy it. That way I could have the other two for you. I don't do this on my charts, have it like lined out like that, where it's like traders going long. Like I know what buy stops are. But again, sake of presentation, this is what I wanted to do. All right. But nonetheless, you notice how the buy stops at, what is that, 37, 47 and 3/4, which is the top one. That's kind of far away. And the market would really, really have to run stops higher up there pretty aggressively, and it can do that. But what I'm trying to get at is the buy stops on the lower ones. Okay, you see how they're very close together in terms of where the price is at, um, meaning that the price levels are very close together. I mean, it's within a point of each other, or might even be within half a point, right at like 37, 45 and 3/4, and then the other one's at like 37.46. So they're really, really close together. Okay. So now that we know that there are buy stops there, or even short sellers having a stop loss, let's see what happens next. So now heading into the open, all right, we'll give it, I don't know, what is this, like 15 minutes. Okay, so this is the first 15 minutes of the market. So what does it do? Oh no, sorry, 20. There's 4 candlesticks, my bad. There's the opening candlestick and then 3 more. So at this point, we are 20 minutes into the open. Sorry. So the first candle and the second candle rallied up into where those buy stops would be. Um, and then immediately rejected to the downside. So it went higher first, and that's important, at least to me, because if it goes higher first and instantly rejects right where I thought it would, where the buy stops are, then if the market really wanted to go higher, then it would make sense that it would have went higher, but it went higher. Well, let me back up for a second. If the market wanted to go higher, it would have triggered the buy stops and then either kept going, or it most likely would have closed in that area or higher. But since it rallied and didn't stay there, and it created a large wick on the upside, that's kind of an indication that, hey, you know what? The market triggered the buy stops, but we want to go lower instead. Okay. And then the next 5-minute candle's that big down candle. And then you see the market kind of not really do much, but it does head back to the opening price. You can see that right there at like 37.44 and 1/4, right where the black horizontal line is at the open. That's the New York opening price. All right. So in this scenario, you know, obviously I told you that this was going to be a bearish scenario, but still, nonetheless, there in that moment, um, stops have been taken, and if we have a downside objective, then we can most likely take a short position. I don't know. I didn't stay up and or wake up rather for this market on this particular day. You know, this is a hindsight example, but nonetheless, watch this. Okay, there it is. There it is right there. So I took the higher stop loss one or buy stops off because the market never rallied up there. And I just left the one on that had the first set of buy stops. And that's why I told you that the second one was also closer together as the first one, because it makes more sense on this chart, because otherwise we'd be overlapped and it would look ugly. Okay. But right there at the top in the red box is that 5-minute candle where it opened, rallied higher, grabbed the buy stops, and then rejected. Okay, and then just like on the chart, just like the chart says, buy stops triggered here, short sellers getting stopped out, and then you can see for the rest of the day the market really aggressively moved lower. So short sellers who shorted above the open probably did really well on this day, especially if they were able to hold their trade into the afternoon, or even right at that 12 o'clock hour where the low was set. That's a good day. That's like from 15 to 45, that's like 30 points. So something like that. So if they were able to get 15, 20, 25 points or something like that to the downside, hey, that's not a bad day. All right. So the idea of working around the open, this is how I look at it, and this is how essentially I trade the S&P.
Sometimes the Dow, sometimes the Nasdaq. I'm not going to get into like what would make me choose between which one to trade. That's kind of when you get into like relative strength analysis and stuff like that, which I'm not going to show you here. I've showed you, if you want to look at that, there is a little bit on that in the what video was that? That was the one I did with Halliburton, and the oil one. Oh, the turtle soup. Sorry, there it is. If you wanna look at a little bit more relative strength analysis, I usually don't do a lot of that on YouTube. I decided to bring it out for that video because it was relevant. But that should give you a clue as to what would make me choose between which index to trade based on that. And I'll just leave it at that. All right. But anyways, yeah. So the short sellers getting stopped out and then reversing, and then even in the previous one, where you saw the buyers getting taken out first and then rallying for the rest of the day. So you kind of see a little razzle dazzle here. Okay, that's what I meant earlier. Is the gunning for stops. So when I read that the market tends to gun for stops, and this was in the 70s and 80s. I'm gonna get to that in a second too. Um, Actually, yeah, I'm getting ahead of myself. Let's go ahead and go to the next slide, and I'll kind of go from there. All right, so inspiration. Okay, so the person who basically inspired this, right? Who inspired kind of this way of trading for me personally? Okay, would be George Angel. All right, so he's the one that wrote about it in the 70s and 80s, and he's got a lot of books, and I'll actually show you on the next slide. But this particular individual, I've seen a lot of his work. I've read a lot of his book. I want to say I have all of them. There might be a couple that I'm missing that I can't get my hands on, but this one particular book, and again, I'll show you in just a second. But this one particular book, actually two different ones, off the top of my head, he talks about the floor traders that wouldn't use stop losses, or someone wouldn't use stop losses, and the floor traders had a tendency to quote unquote gun end quote for stops or something like that. So basically, what he was saying is that the floor traders would be on the floor, I guess, doing their thing. This is how I envision it. You know, they're on the floor. They're doing their thing. I guess they're doing the whole hand signals or whatever, the little 2 and the 4 and all this and that, open outcry, if you will. And these floor traders would essentially take traders out of the market. And so I just found that really, really fascinating. There's no other word for it. It's just like, okay, that makes a lot of sense. And so when you go and back test, you know, you look at these charts and it's like, okay, well, do they really do that? You know, or is it hidden? Sometimes it's very blatant. It's very like in your face. You can tell like, oh, that was definitely market manipulation. You know, if there's a really, really big wick to the upside or the downside, or sometimes if it's one candle that has wicks on both sides, obviously, you know, but if you really pay attention and really focus on, okay, where would stop losses be, you know, below recent lows or above recent highs and things like that. And then you actually study the market near the opening prices for the indices, you can tell that a lot of the times stops get ran, period. Um, Now, with the examples that I showed you in this video, it's not going to be that clean every single time where it's just going to blatantly run higher first and then run lower, or run lower first and then run higher. Sometimes it'll just open, rally higher, and then keep rallying higher, and that's it. And that's not a day where it particularly ran stops on the downside first. It just doesn't always do that. You know what I mean? Like there's certain days where it will and certain days where it won't. So it kind of really just depends. There's a lot of interesting days to pay attention to. You do have like when contracts expire. You know, you've got like the third Friday of every month. You've got certain monthly contracts that end. Just a lot of different expiries for futures, and that works for not just index futures. I mean, that's across all futures. I mean, every contract has an ending date, has an expiration date. And so on those particular dates, sometimes the market can be a little bit more volatile and stuff like that. And so those are the days that I'm talking about, that I would really pay attention to as well. And so, like I said at the beginning of the video, guys, I mean, you just got to dive into your charts. You got to look for this type of stuff. And when I really started to focus on this is what elevated my trading, all right, especially for the index futures, all right. But anyways, I'll go ahead and show you some of the books, and then the two of my favorite from Mr. Angel, all right. And okay, if you look up George Angel, if you go into Google, you type in George Angel and you press enter or whatever, the first thing that does come up is a little something from the CFTC. He got in trouble. I think it was the early 2000s. All right. He basically marketed his system, some type of trading that he did, LSS or something. He was marketing it as it was as if it were real results, but they weren't. It was like demo or something, and he got caught lying, and the CFTC came down, gave him a fee and everything and all this and that. But outside of that, I respect the guy a lot. And, I don't discount someone just because maybe they've been to prison or maybe they been to jail or been arrested or something like that. Like, I don't judge people. Okay. And even it just doesn't make sense because like the information that are in these books, okay, whether he goes off and does something stupid or whether I never hear from him again, the print on these books won't change. The information doesn't change, whatever type of person that he may choose to be. So the information is valid. It doesn't matter. All right. It's just like Kevin Trudeau. They threw Kevin Trudeau in jail, but nonetheless, the information that he put out is still very powerful and still very useful. So just because George Angel got in a little bit of trouble, okay, I've been in trouble too, not with the CFTC, thank God, but I was in trouble a lot when I was a kid. In school suspension, getting suspended from school. Like we've all done bad things, okay? But nonetheless, the point I'm trying to get at, okay, these books, I have all of them. This is my dining room, actually. Okay, those are the stairs. If I walk downstairs into my dining room area, this is the dining room table that I have, okay? And just basically put the books on there, took a picture of it, and that was it, all right? So my favorite books from this particular set is the one on the bottom and the one on the top, okay? So the one on the bottom is titled How to Triple Your Money Every Year with Stock Index Futures. Now, why is that my favorite one? Well, or second favorite one, sorry. Why is that? Well, because this is where he talks about gunning for stops, as well as the top one. I'm going to get to that one in just a second. But how to triple your money every year. I got it used. All these books are used. You can't find any of these books brand new. I mean, they're so old, which is why I told you at the beginning of the video or somewhere in the middle, these are written in the 70s, man. 1970. I know winning in the commodities market, the top one, that's 1979 for sure. Okay. And so this man was talking about market manipulation in the 70s. And that's the earliest text that I know of actual market manipulation. I haven't found any books prior to 1979 that have introduced that concept or something like that. But yeah, so it's like kind of like pioneer smart money, if you will. Okay, he didn't directly call it smart money, but that's what it's known for today is, the people who manipulate price, the people who move price, they're smart money. Okay. So he was technically in my book, I consider him talking about smart money before it was actually called smart money. Okay. And it's in there, page 130, third paragraph. Okay. So if you have that book or if you can find it somewhere, or if you want to outright go and buy it, There it is, page 130, third paragraph. It's there. Okay. But yeah, How to Triple Your Money Every Year. He does talk about market manipulation in there as well. It's in the later chapters. A lot of his stuff, I don't really, I don't take all of it. Okay. Just like certain systems or certain chart patterns and stuff like triangles and things like that. Like I don't do those. Okay. Like y'all know me. Okay. But those particular gems, if you will, are make the whole book worth having. You know, I've read, actually, with the exception of agricultural options, I skimmed through that one. I read a lot of it, but I skimmed through a lot of it as well. Um, but everything else, yes, I pretty much read through. So Winning in the Commodities, great, amazing book. I think everyone should own that one. And How to Triple Your Money Every Year with Stock Index Futures. That one is a really, really good one to have as well. But as of January of 2021, Happy New Year, okay? But as of today, it's almost impossible to find Winning in the Commodities market. We've been, me, myself, and Trade House, we've been putting out, recommending winning in the commodities market for so long that they've been bought now. Okay, everyone's bought in the damn book. Ain't nobody can find it anywhere. Okay, so good luck finding that one. How to Triple Your Money Every Year with Stock Index Futures. You might be able to find that one. If you can find it for like $30 or less, I would pick it up. All right. I don't want to make this video too long, but you know, here's a selfie of myself. I took this earlier today, my little S&P hat. But there it is, How to Triple Your Money with George Angel. Okay, so I have it. You know, it's tangible. I literally only brought it out. It's actually in my it's in the other room on my bookshelf next to How I Made $1 Million Last Year Trading Commodities by Larry Williams, and a bunch of other Larry Williams books as well. But I brought it over into my room today just to take this for you guys. All right. So I hope, you can appreciate that. All right. So with that being said, guys, I appreciate you and thanks for watching. So if you haven't already, please like and subscribe and leave a comment. Let me know what you think. All right. And yeah, be sure to subscribe so that way you don't miss future content. All right. So have a blessed day and I will see you in the next video.